What is up, guys? This is Shivansh coming back at you today from the Shivansh Nigam way. And let's read the disclaimer first. Hope you have read it. You can pause the screen to read it if you want to. Today is the first lecture of the fundamental analysis. The reason I'm speaking in English is because I also want to improve my spoken English side by side as I'm making YouTube videos. I think that is going to be very helpful in my career going forward. So, without wasting your time, and also there is one more thing that I would like to mention, that I am actually recording this video while the market is open, so I might just switch tabs around a little bit just to keep an eye on my intraday trades and my holdings and investments. Please don't mind it. Okay, today is going to be the first lecture for fundamental analysis. It's going to be a very short and sweet video, and we are going to be talking about what is fundamental analysis in general and what are the types of investing that a fundamental analyst normally does. So what are the investing models? We are not going to go into the details of the financial modeling as of now. Maybe in the subsequent lectures we will discuss that, but for now let's just get started. So, fundamental analysis. Now, before watching this video, I'm pretty sure you might have watched a lot of videos, read a lot of articles about fundamental analysis, so you might already have like a fair idea of what it is all about, but I would still like to give you my take on it. So, according to me, fundamental analysis is just basically analysis based on data points. And okay, there's no way to confirm it, but this is something that most people say, that all the big institutions, the big hedge funds, mutual funds, the FIIs, FPIs, DIIs, and the RIIs, that's the regional institutional investors, all of them use fundamental analysis in one form or the other. And that's a very important point to note, one form or the other. So we are not saying that they use fundamental analysis, but it is said that they use fundamental analysis in, like, maybe indirectly. Now, there indirectly means a big difference to us. It's just like heaven and earth. It's just like they are having a lot of technical parameters as well. They are having a lot of Greeks, a lot of option Greeks, a lot of metrics like alpha and beta. But anyway, let's go ahead in a simple language. Let's discuss what is fundamental analysis. So, if you are analyzing a company or trying to speculate a stock price just based on data points, so that could be any data, it could be a GDP data of a nation, and then you're trying to just predict the whole economy of a country, whether that will go up or down. It could be something like an employment data, it could be earnings results, that's the quarterly results that the company is used to post. So, naturally, the tendency is to believe that if the company has earnings, then that would reflect in the stock price ultimately in the long term. So it's a very important point to note that a fundamental analyst, he believes that market can be irrational for the short term, but in the long term the market has to align with with whatever the fundamentals are, and the market just has to stay along that average. So maybe if a stock whose intrinsic value according to fundamental analysis, it comes to be 100, and that stock might even go to 125 or 130 odd levels, and that stock might even drop to 60 or 70 levels. However, there's one thing that we must note here, and that is that the stock eventually in the long term, it has to come back to 100. Now, suppose if we are talking about the same stock, but now that the stock has some earnings combined to it, it has some positive earnings data combined to it, it has some positive financial ratios combined to it. We'll come to all of these in detail, but let's suppose the company is making money. So what happens is that that money is going to be reflected into that company's stock price, and the fundamental analyst, he believes that okay, the stock is 100 right now, let's say in 5 years from now the stock should become 150 based on this earnings, based on the expectations, the estimates of the earnings. So he just believes that okay, in the short term the stock might fall to 70 or 60, but in the long term the stock just has to align with that fundamental. Okay, so that is what they believe, that is what fundamental analysts believe, and that is what fundamental analysis is all about. A lot of this will make a lot of sense to people who are really from the economical background, or really from commerce or economics. It will make sense because it's very logical. Fundamental analysis relies on logic. It tries to buy low and sell high, as opposed to technical analysis, which tries to buy high and sell even higher. So we'll come to that. Now, before I start this fundamental playlist, I would like to tell you that I do not rely on fundamentals alone. This doesn't mean that I do not look at fundamentals. I do. I look at PE ratios, especially in the indices. That's the most important index is your Nifty 50, of course. So I do look at PE ratios. I do look at some of these fundamental values. However, I do not like purely rely on fundamental analysis to make my investment decisions. That's something I do, and you can decide what you want to do after watching this entire playlist, right? So, why do we need to study fundamental analysis? Like, why do okay, but if I'm not from a background that understands all of these data and stuff, I would be like, okay, this is very complicated. Why do I need to study this? Firstly, I would like to explode a myth here. The myth is that all of this finance related stuff is very complicated. The fact is that it just has a complicated name. So when you talk about price to earnings ratio, and it's called the PE, it's called the PB. Those kind of short forms, they look like they are very complex. But price to earnings ratio, it simply means what it is. It means price divided by earnings. And when you talk about quarterly results, it simply means, okay, what is the company's earnings? What is the company's profit? What is the growth in its revenue? So all of these terms, the terms that these economists have coined for us, that's very complicated. They're very complicated terms. But there's something that you need to realize here, that these terms are complicated, but the meanings that they imply, or the things that they point to, are actually pretty easy to understand, to the extent that we can use them. We don't need to do a PhD in these topics, but we can just learn them to an extent so that they are usable for our everyday trading or investing journey. Normally, fundamental analysis is used more for investing than for trading, and I have brought to you three models in this video. Now, they are a part of a bigger financial modeling of mine, but for the sake of simplicity, let's skip the calculation part and let's just talk about the financial models. So basically, there are three kinds of investing that okay, I should not say that, because there are literally 1,000 different kinds of investing that you can do based on fundamentals alone. But there are three, something that is broadly considered as relevant in the market right now. The first is quality investing, the second is value investing, and the third is growth investing. So I have actually plotted a chart for you, and this chart has been taken from an online source. So what does this say? We need to analyze, okay, what is quality investing, what is value investing, and what is growth investing. Now, before going into this chart, let's talk about quality and value investing, and then we will come back to this chart at a later point in this video. So what is quality versus value? Well, quality investing just focuses, if someone is following the quality investing model, he's just focused on the debt to equity ratio of the company. He's just focused on the return on equity, and he's just focused on the earnings per share of the company. So a lot of focus is on the earnings of the company. So it kind of like is growth investing. Now the difference is that growth investing is solely focused on earnings and estimating those earnings. So the example that we talked about in this earnings data is actually a form of growth investing. In growth investing, what you do is you try to estimate the future earnings of the company, and you estimate, okay, this is how the fundamentals of the company should change according to this growth. Now, it's very hard to actually predict what a company might do, because if you might, just think about it, a lot of companies that we know have actually picked up in the recent decade, and they were like not even known figures back in I would say 2000s or 2005. If you talk about companies like Netflix, Amazon, the companies that are topping the chart these days, the companies like Zoom, right? So these companies, they have actually created their name recently, and it was very difficult to identify these companies back in, I would say, the 2000s, right? So anyway, what does a growth investor do? What does a growth investor do? Growth investor, he will primarily just focus on growth that a company has. It could be any form of growth. It could be maybe the company is trying to increase its assets, trying to reduce its debt, which is also a growth. But mainly the focus is on the earnings that the company is getting. Now, what a quality investor does is that a quality investor, he tries to, go a little bit deeper than growth. He tries to go into some financial parameters. I mean, these are the three main parameters that are used by the National Stock Exchange. So these are the three I have listed. Debt to equity, return on equity, and earnings per share. We will discuss about each of these parameters in detail in subsequent videos. If you would like to know about any of these, you might just simply Google it for now. But mainly, if you talk about them, they are just ratios of earnings, right? They just have the E word associated with them. So the quality investor, he is looking at earnings, but he's also looking at price. On the other hand, a growth investor, he's just solely focused on the earnings, and he just wants a bargain or a throwaway price. While a quality investor is also considering, okay, how has the price moved in tandem with the earnings. So that's what the quality investor wants to do. He wants to judge earnings per share and stuff like that. Okay, so that's what the quality investor does. And also there's one more thing that the quality investor does, is that his approach is basically just find the top quality stocks, find the stocks that have good fundamentals, a good promoter integrity, there's a good that, and just stay invested in those stocks for the long run. Just buy and hold, just keep buying and holding, and do not sell unless these quality parameters change. So the quality parameters that you have used to initially identify that company, if that changed, then maybe you can exit that company. But till then, just buy and hold for the long term. That's the focus of quality investing. I think investing in general is buy and hold for the long term, but that's what quality investors do, and that's their characteristic that makes them different from value investors. So quality investors, also one more point that you need to note here is that quality investors do not care for the price. I mean, they care for the price in respect to earnings, but they will not refrain themselves from buying something at a higher price. So for example, if we talk about SDFC Bank, let's say SDFC Bank is right now at 14 to 1500, and if a fundamental or a value investor says, okay, the value of the share is just 800 rupees, I'll buy it below 800 if I get it, well, that value investor might just be waiting for the rest of his life, because HDFC Bank, I mean, these good companies, the quality investors believe that these companies have quality and they are never going to touch their intrinsic values. Even during the COVID-19 crash, mind you guys, even during the COVID-19 crash, there were a lot of companies that were belonging to this quality group, and they didn't even come close to their intrinsic values. So just forget the thought about them falling below their intrinsic values, which is a value investing model. But so overall, what a quality investor does is he does something like an SIP. He does something like, I mean, that sort of thing. So he doesn't care what the price is. He just says, okay, this company has quality and this company will grow no matter what happens, no matter what a price I purchase it at. And that's why the quality investor, he just focuses on just buying more and more shares, just accumulating that company during his accumulation age. And that's what the quality investor does. But he also focuses on parameters like the promoter integrity. I mean, the promoters must be strong. The promoters must have a name. The company, it must, if the company has a price, then it must have reasonable earnings to back that up. On the other hand, growth investing, so they do not focus on price. They do not even care about the price. They just focus on the earnings, and okay, this is the forecasted price. So a lot of people do that. A lot of people do not look at the current price and whether the current price is in sync with the previous earnings or the past earnings. Growth investing is just concerned with forecasting what the future is, what this company is going to be, and that is your growth investing. Quality investing, however, also considers, okay, is this company in sync right now with the earnings that this company is producing? Is the price still okay? I mean, the price doesn't need to be below the intrinsic value for quality investors. For value investors, they look at some financial ratios like the price divided by earnings, the price divided by the book value, the dividends the company is paying, and the return on capital employed. Now, the main difference is that quality investors use ROE, while value investors, they use ROCE. Now, the difference is that in ROE, you're just calculating the physical tangible returns that the company has produced for the shareholder on equity. On ROCE, you are estimating, okay, at this value, suppose if Nifty is at the valuation of 15, right now Nifty is at a valuation of 37 price to earnings. The P ratio of Nifty is 37. you are saying that, okay, I need to employ 37 rupees to get 1 rupee. So ROCE will simply be 1 upon 37. And percentage, of course, so you have to multiply that by 100 if you want a percentage. If you want a ratio, that's just 1 by 37. So it's basically how much return I'm getting versus how much capital I'm employing. However, there's one thing to note here, that ROCE is not actually a physical tangible thing. So Nifty, I mean, currently I'm saying, okay, for every 37 rupees I put in the market, I get 1 rupee back. But that might not be true in the future, and it has been in a lot of cases, might not be true. While earnings per share is like related to, okay, what earnings the company has already produced. So this is an important fact of difference. Value investors, one key point here to note is that value investors, they will never buy a company at high valuations. Valuations is the key to value investing. You just want to buy a company when it is available at throwaway prices. You just want to buy a company when it is available at a very bad price to earnings, a very bad price to book, but it must give a high dividend yield, and the ROCE must be such that you need to deploy a very less capital to get a very high return. So value investors, they sort of get beaten by the market. I mean, that's what has happened during the past decade. I will just like to point here that, okay, I have taken some indices. So a lot of these indices don't have ETFs associated with them, so there's no way to actually benefit from the gains that these indices are offering. But there is an index called low volatility that I haven't talked about today. I'll talk about that later. But this has an ETF associated with it, value. So this is the Nifty index that, the Nifty index that actually, incorporates the value investing model. And there is a tie-up between NSE and I think some other company. I cannot recollect the name of them, but they are responsible for the index management and stuff. So anyway, you can find them on the NSE website or the fact sheet of this index. But the value 50 index, TRI means that the dividend yields have also been included in these calculations. The value investing model has returned since April 2005 a CAGR of 10.27%, as opposed to what a Nifty 50 has returned, that's 13.07%. So Nifty 50, I mean, someone who's just buying an index fund is getting a 13.07% CAGR. Someone who is doing value investing is getting a 10.27% CAGR. And imagine the tax implications, imagine the turnover generated, the constant churning of portfolios when you are when you are using a value investing model. You just have to keep buying and selling stocks, and you just increase the amount of tax you pay. While if you just want to invest in Nifty 50 TRI, basically just buy an index fund, just buy an ETF that's just replicates the index, and you are good to go. There's no tax implications, there's no extra turnover that you are generating. And I think that would help you in the long run if you just go with an index fund. I mean, that can help you save a huge amount of money in terms of taxes. Now, Nifty 50 has generated this CAGR. Now, if we talk about the quality investing model, and this is something that I use, so the quality investing model has actually outperformed Nifty and value investing by a lot, and Nifty also by a lot. Now, this 5% is actually huge. It's a huge difference, and the return is 18.4%. When there are other forms like the strategic forms, the alpha, and then you talk about low volatility or low beta and stuff. So these all forms exist, and that's okay. That works, right? So anyway, we'll talk about all of these later. But before ending this video, I need to tell you something. Note that in value investing, I have also broken down the returns here. So between 2006 to 2010, the value investing model was actually the best performer out of this group of 6 TRI indices that we have taken. The plural of index is indices, right? So anyway, value investing was actually the best model back in those 5 years, 2006 to 2010. But since the past decade, value investing has even failed to beat inflation. So you were just better off investing in a fixed deposit or savings bank account than following a value investing model in the past 10 years. Now, a caveat is that this might change. Okay, I mean, the past returns are not a measure or not an indicator of future performance. So this might change right? And it's nothing like, okay, this is just something that has happened and this will happen always. Because I mean, someone looking at this data in 2010, he would be just all for value investing, and that's where the craze actually originated from. And then the next decade, the value investing model doesn't even perform. So what I basically do is I have not all of these, but most of these financial models in some form of asset allocation. So instead of going all in, going 100% of 100% on one model, you can actually employ a model that includes quality plus value plus growth, and you'll be just good with that, right? You'll be just very good with that. Now, growth model, if you want to look at the CAGR of growth model, I would just say look at the CAGR of low volatility. It kind of pretty much works the same. So this is the CAGR of growth model. So growth and quality have actually performed very good in the past 15 years. Value, on the other hand, hasn't performed that good. But we are also looking for consistency of returns. So the most consistent returns that I see here is the one that the quality investing model has. I mean, the growth also has some sort of consistency. Momentum has the most consistency. I will talk about the momentum later. The momentum investing, I would say it's the biggest weapons, the king of all sort methods of investing, but it's a technical form of investing. It's not a fundamental form, right? So the momentum has shown the highest consistency with the least standard deviation. That's something that you need to consider here about momentum investing, right? So I mean, you can just go ahead and screenshot this, evaluate and apply some of your own regression and correlation methods. Maybe you can apply some sort of statistical tests to just see whether there is a significant difference between any two returns. I mean, that's what financial modeling is, right? And you don't need to do that. Believe me, you don't need to do that. Even understanding all of this basic stuff at a surface level is pretty much enough for the rest of your life. I mean, you don't need to generate an 18.86% CAGR. You are just better off investing in an ETF, investing in Nifty Bs, and getting a 13% CAGR. That will help you actually reach your goals as well. So there's nothing bad in that. But of course, if you are going for the 18.86%, you have to do that work. You have to study what these CFAs study, right? I mean, I cannot lie to you on YouTube. And this is just something that you have to do. Stock market is simple, but it's not easy. It takes a lot of time and a lot of effort and a lot of work. So I have given you these three models right now, and I'll just, this was the difference between ROE and ROCE. And then we have a quality investing. You can go ahead and read that. Value investing, I have already told you about all of these things, and that's the slideshow that I have for today. I hope I have kept it very short and sweet. Oh, I have taken 22 minutes. Okay, that's like that comes on the shorter side of things when we talk about my videos that are 1 hour long. So before I exit, I would just like to see what's happening with my trades, and then we'll just close this video. Maybe talk a little bit about Nifty, and then we'll just close this video. So I'm not logged in. Wow, they have a timeout or something. Okay, I need to enter a password. Let's do it. Yes, I would like to update it. And here we go. Here we go. Oh, we have some decent returns. We're looking to book them here because the market is just about to close. So what's our position right now? Market is running crazy. SBI is running crazy. Okay, we'll see. What about the swing positions? Well, it looks good. Actually, Nifty is at a lifetime high right now. So I have a question for you. What do you think, like which kind of investing would actually work on Nifty right now? If Nifty is just making, I mean, in the current scenario of the market, where the market is just breaking highs and just going, just going on an absolute rampage here, just making those higher lows and higher highs. What kind of investing, according to you, would actually work better in the backtest if we applied that backtest to like 2020 and the start of 2021? Quality, growth, or value. Comment down below, let me know, and if you like this video, if you found this video helpful, be sure to go ahead and subscribe to this channel, because I like to bring educational but entertaining content for you. And if that's the kind of content you are up for, well, you are welcome to my community. Leave a like button for the YouTube algorithm. I'll see you next time. Bye bye for now.